Welcome back. You're with us here on CNBC-TV18. We are starting closing bell half an hour early, and we got the entire closing bell team here. Rima, hi. Surabhi, hi. Nigel, welcome back.
Long haul, Prashant? Good going.
But it's, this is the definition of the interim budget, right? I mean, it's actually just, in a way, a hand-holding exercise until, of course, the big one comes through in the month of July. Markets have been very well-behaved, no real big volatility. They've been quiet. I mean, 15 points lower as we speak on the Nifty, 21,710. We'll discuss more markets, stocks, etc. in a bit here. But let me go straight across to Mr. Amitabh Kant, who's the G20 Sherpa and the former CEO of Niti Aayog, who's joining us with his reaction to the budget and what we've heard. Mr. Kant, good afternoon. Great to have you with us here, sir. Prashant this side. Your first thoughts, first impressions of what you've heard. Many were thinking that this is going to be, a full-fledged kind of a budget. I think that view was in the minority. Most thought this will be interim, and we've got exactly that. So I have two questions. One, do you think what we've heard will be continued through in the big budget in July, or will we see big changes? And two, what are your first thoughts on what we've heard? Capital expenditure, spending growth, and of course, the fiscal deficit and the consolidation we've seen there. Go on, sir.
So, Prashant, I think it's a budget by a government which is demonstrating confidence that it will come back. And also, it's a budget by a government which believes in fiscal discipline. So I was quite impressed by the fact that it's talking about fiscal deficit at 5.1% and then bringing it down, laying down a clear roadmap for 4.5% the subsequent year. And I think that's really critical because that would really mean that government will borrow less, interest rates should come down, the private sector should be able to access resources at a much lower rate of interest. We should be able to kickstart private sector investment in a much bigger way. I think those are all critical messages to be sent out, and I think this demonstrates a huge level of fiscal discipline. Also, the fact that, from 2013-14, from 1%, it has taken the capex to about 3.3%, and now this year to 3.4%. Now, government has done its bit in terms of capex spend, and my view on that is that we should now crowd in private sector investment into infrastructure as well. And that will be important because if you want productive efficiency in the economy, if you want good private-public partnership, if you want good operation, good design, good execution, you need to bring in private sector in a big way, and that's important in all sectors, including, we need private sector to come into areas like railways also. And I think that, to my mind, is a clear signal that government wants private sector to come in over a longer period of time. And the third is this clear messaging that which to my mind is very important, that if you want the country to grow at rapid rates, then you need the states to improve. And a lot of reforms now need to be driven by the states. So if you're putting in 75,000 crores saying that this is linked to reforms, and you are going to give money for infrastructure creation if you carry out reforms, it's a big message, and it's all milestone based. So it's incentivizing the states to push for reforms. And if the eastern part of India, which was talked about, if the eastern part of India can really avail of the 75,000 crores, they will really kickstart infrastructure in a big way. And I think the focus on the 1 lakh crore for R&D for the private sector, that will be critical. But, one point I want to make, which is about yesterday, the finance ministry reducing the duties on a vast range of items which are used for mobiles. Mobile manufacturing, a range of items, the duty rates have been brought down yesterday. And I think that will make India a very, very competitive in the global value chain, which is to make India a leading manufacturing nation for export of mobiles from India. And that is a good move to my mind. And so these are my few comments.
Mr. Kant, good afternoon, sir. Great to have you on the program. Just to press that point a little further, Atmanirbharta and manufacturing, Make in India. I was speaking to, a couple of members of industry and the tax circles, and I think one surprise was that while the sunset dates on several, tax exemptions were increased, for instance, Gift City, etc., that all-important 15% concessional tax rate for new manufacturing units, that was actually not increased. So I just want your perspective on how we should read this. There's a lot of talk about Viksit Bharat, becoming a developed economy by 2047, but no specific new announcements or no big mention on manufacturing. I mean, schemes like PLI, etc. So is it just because it was a vote on account and maybe we'll hear more big bang stuff in July? Is that how we should interpret this?
Yeah, I think you should wait for a long-term budget. This is an interim budget, and I think it's truly an interim budget. It's not the main budget, so I think you should wait for that. And that's why not too many giveaways in terms of taxes, etc. I think we should wait for the longer budget. Don't have too many, don't pin your too much hopes on too many policy announcements at this stage. This is a very good interim budget. This is an outstanding interim budget to my mind.
Absolutely, and very crisp, very short. And on a side note, we were planning for almost a 2-hour budget speech, so we had to change up as well. Mr. Kant,
so the speech was truly designed for an interim budget, and
absolutely.
I think it's hit all the right notes for an interim budget, and I think you should wait. You don't expect too much. Wait for the long-term budget, but I think as an interim budget, it's an outstanding budget.
And I absolutely agree with you. Mr. Kant, just to one quick point on divestment. It's come up again and again. I mean, I think the RE has been revised to 30,000 and the budgeted estimate is 50. This is as good a time as any. I mean, maybe the best time for the government to collect funds. And many in the market believe, well, will we see that in a big way? And why not in the first year of the new term? Yeah.
No, I totally agree that I'm a great believer that if the country's productive efficiency has to improve, if India has to grow at higher rates, and incidentally, my view on this, on the nominal growth rates, is that it's very moderate rates have been put into the interim budget, and probably we'll end up faring better. But my view on this is very clear, and I've been a long-term advocate of the fact, as the Prime Minister has been advocating that it's not the government's job to be in businesses, except a few areas. Government should disinvest, government should do asset monetization in a bigger way. All this helps to bring in private sector, and I'm a believer that private sector brings in greater productive efficiency in the long run. In the interim period of the last 3 to 4 years, government has created a lot of infrastructure, but it should, in a transparent, competitive manner, put it out for private sector to bid and do operation and maintenance. A lot of more disinvestment should kick in in the coming years, and that will bring in, because the government will get the right values. This is the best time to get the right values. Otherwise, and it'll bring in great efficiency into the economy in long term. If you have to look at a 2047 vision, it's very clear that private sector will have to play a far more critical role.
Mr. Kant, while in the speech there was a focus on women, youth and farmers, etc., and even the rural economy, but we haven't seen big measures which can boost consumption, particularly at the rural end, which some people in the market find surprising considering we are in an election year. How would you respond to that?
Well, I'm not a great believer in a consumer-led growth story. I'm a great believer in infrastructure-led growth story. It takes a little more time, but in the long run, that's what drives the economy. If you're looking at 2047, if you want to get into 9 to 10% growth rates over a long period of time, I mean, many countries of the world have done it. There are challenges in the global economy. But the only way for India to grow on a sustained basis is infrastructure. And that will create rural demand. I mean, if you're going to create roads in rural areas, if you're going to put electric buses in rural areas, if you're going to provide rural houses, which the budget does, if you're going to do a rural solar rooftop, if you're going to provide piped water connection in rural areas, if you're going to do toilets in rural areas, whom will it benefit? It will benefit the rural population. It should all be infrastructure-led, which will create great consumer demand in due course. And that is how the country will grow in the long run. So don't get into this bogey of creating artificial consumer demand.
That's put forward forcefully, as always. Mr. Kant, just one last question from my side. You wear so many hats. You're so involved with the industry on so many in different industries, really. Will we see, private participation in infrastructure spending picking up in a big way? I mean, can you see telltale signs of that? Your thoughts, sir?
I think post-election, you will see, after this government comes back, you will see a lot of more private sector. Private sector investment is going to kick in a big way. I mean, you can see all clear signals of that. And capacity utilization is at a good high. Interest rates will come down. There's good consumer demand. I only wish that the global scenario also improves, and you will see long-term private sector investment. We should put out many more roads, many more projects, well-structured, fully de-risked. After taking all approvals, we should put those SPVs out into the markets for private sector to bid for, and you will see good demand. I mean, move over to a lot of more well-structured, well-cleared, well-defined infrastructure projects, and you will see very good bidding for those projects.
Okay. Mr. Kant, so then to wrap it up with final thoughts, I'm going back to what the finance minister was saying in the speech when she outlined some of the key priority, pillars for this government, for Prime Minister Modi, where she mentioned Garib, Mahila, Yuva, and the Annadata. As we look over to the concept of the Viksit Bharat, and she said that the next 5 years will be years of unprecedented growth, and that fills us with a lot of hope. How do you think the priorities will shift, if at all?
No, I've worked with this government for a very long time, and this government actually believes in inclusive growth. It believes in cutting across all segments. It doesn't, when you're implementing schemes on ground, and I did the aspirational district program with this government, it doesn't look at any particular section, it doesn't look at caste, it doesn't look at religion, it doesn't look at creed. It believes in saturating a scheme at the grassroots level. So if you're saturating all schemes at grassroots level, you're making a dent on poverty. And that's why, the multidimensional poverty index shows that 25 million people, such a vast segment of 25 crore people have got lifted above poverty line, because you've actually taken all the government schemes and actually saturated them at grassroots level. So the level of implementation has just been enormous. I mean, it's been phenomenal level of execution on ground at the grassroots level of all the central schemes, and that has made a difference to the lives of citizens. And I think we should continue to just do that. Have schemes which get fully implemented. And the power of digitization has really helped us. The benefit of that has been just enormous in terms of better quality implementation on ground, because the leakages have been very few now. I mean, there's just no leakage. Everything is reaching the actual beneficiary.
All right, Mr. Kant, we appreciate you joining in here on CNBC-TV18 and giving us your first thoughts on the budget. Looking forward to chatting up with you rather soon.
Thank you.
Well, for the markets as we speak, we are trading at more or less the flat line, mildly move into the green. That's because a couple of big names have moved up. Reliance Industries has moved to the high point of the day, so I think you'd like to get that stock back up. It moved into the green. Now it's recovered a little bit, and that's a big weight in there. Adani Enterprises as well, smashing it out of the park. In the last few minutes, you have Adani Enterprises that's just taken off. That's moved to the high point of the day. And Adani Ports as well is seeing a bit of a pep up as we speak. Shiv Puri, founder and managing director at TVF Capital Advisors, joins us on the show. Hi, Shiv. Good afternoon. Thanks so much for joining in. Well, I wanted your first thoughts on the budget. At the start of today, people were saying, let's see if there is something for the rural economy to pep it up. And also the eye was on capex spends. What is your first thoughts on what we've heard?
I think the first thoughts are really fiscal discipline, which we have seen across Heard from other people across the board. I mean, it's interesting. We're moving from a glide path of, say, 5.7, 5.8% to 5.1, and the U.S. fiscal deficit's at 6.4. The roles have reversed, and I think this is a budget that really shows fiscal discipline at the moment. That's India is going to be hopefully in the JP Morgan bond index by July. That's the expectation. So if you've got fiscal discipline, you've got the ability to attract foreign capital into the bond market, that is going to bode well for domestic, for liquidity and for the currency. So I think the macro is in really good shape. The other highlight, of course, is on CapEx. While the number's up, I think about 11%, it's actually up a lot over a 2-year basis. Maybe 45 or 50% is the number for the last 2 years. So there's a major focus out there, and of course that has ripple down effects onto many industries in India. Rural spend is up, but I think that is much needed, and we all know the rural economy is a little soft. So perhaps something a little bit more happening on that front would be nice to see, I guess, when the full budget is presented in July.
No, absolutely. Shiv, hi, good afternoon. And every time I see you, you look younger. I don't know what the secret is. Congratulations.
Thank you.
Shiv, I don't think we've spoken after that entire HDFC Bank sort of saga played out post-earnings. Financials is your number one bet, has been for years. How do you read this entire thing on HDFC Bank? And do you think this is a great opportunity for those who want to buy?
Well, first, let's start with the industry. It's quite clear that we have a liquidity crunch in the market. I think the shortfall is something to the order of 45 to 50,000 crores. So therefore, deposits the rates have gone up, and at the same time, you're going to see so the NIM pressure is therefore clearly there. At the same time, you saw over-provisioning during COVID, and so NPAs were artificially low, and that is going to course correct and come to a more normal cycle. So I think temporarily you're seeing across banks slight NIM pressure as well as slight increase in NPAs. Banks are in pristine condition. It's just the base was really low. So that's applicable to all banks. I think specifically with HDFC, the issue has been around the merger. And pre-merger, there was the expectation that the earnings would be accretive, that the NIMs would remain steady. But it seems that along the way, once they've actually presented the combined company, there's been pressure on both those fronts. I don't think that is something that is structural. I think it's an issue that will get fixed over the next few quarters.
So Shiv, you would be looking to buy into HDFC Bank at current reckoning, at current valuations?
Not making any recommendation on any specific stocks, but what I would say is with respect to HDFC, as you see, that there is pressure which is very cyclical in nature. There is no structural issue that is there, I think, with the bank long term.
Shiv, would you bet on more interest rate cuts by the Reserve Bank of India based on what we've seen, the lower gross borrowing by the government, the decline that we've seen in the 10-year bond yield? And if that's the case, do interest rate sensitives, apart from financials, which you spoke about, do they make an attractive bet? I want to know what has changed for you in the last 24 hours with this budget.
Well, I think along with the budget, also you're seeing global interest rates that are softening. That's happening over the last couple of months. I mean, the Fed didn't cut rates yesterday, but if you look at the 1-year rate, the 3 and the 5-year, even the 10-year treasuries, they've all softened quite a bit. The 10-year has gone from 5 to 4%. So clearly the trajectory is for lower interest rates globally. Inflation is coming down globally. In India, we're seeing the same thing. Inflation is within the band. My sense is that the RBI is a little cautious on what's happened on certain segments of retail lending, as well as that inflation is still on people's mind front and center. But as that recedes, I think interest rates are only going to head lower. And like you said, with the fiscal deficit at 5.1% of GDP, if we do manage to get to that number, that's an incredibly strong fiscal position to be in for monetary policy to ease.
So, Shiv, then sort of putting all these things together, really, let's talk about the overall positioning for anybody who's interested in Indian equities, right? We are heading into an election year, and as we were just discussing earlier, we'll probably get a better sense of bigger policy announcements or anything more big bang, in the second half of the year. So therefore, given where we are, where valuations are, the banking issues that we've already discussed, what should the stance be, or what would your stance be on equities in the foreseeable future?
I think the backdrop for equities continues to be very constructive. And there are a few reasons for that. One, of course, is overall economic growth. You're seeing that to be pretty strong. India will this year undoubtedly be, again, the fastest growing large economy in the world. Therefore, you see it'll attract not only domestic capital, which we're seeing, but also foreign capital. Second, there is a push on very productive uses of capital within India, which is infrastructure and capex. Third, you are sensing from entrepreneurs increased optimism in doing capex and expanding capacity in the manufacturing sector. And fourth, you're seeing consumption increase, whether it's in domestic travel, healthcare, and other services. So when you put all of that together, along with the fact that you will see global interest rates declining and likely, therefore, a weaker dollar, that bodes very well for the Indian equity market. So I continue to remain constructive.
Shiv, just to wrap it up, you like financials. I remember you like hospitals as a space. Just what else as themes?
Financials, you have healthcare services, which is hospitals, consumer, which is not only just FMCG, but consumer services. I think these are the three big areas. Manufacturing selectively, I'm not sold on the China plus one just yet. There are some pockets of beneficiaries, but there are some really incredible manufacturing companies in India. I would say these will be the few themes that we look at this year.
Shiv, you mentioned consumer services. I have to ask you if you could elaborate. I mean, are you talking things like hospitality, tourism, or what exactly do you mean by consumer services?
Yeah, hospitality and tourism as one area. I mean, I think what you're seeing happen is also quite interesting, where you saw this over the last decade, where a lot of people in China, when they got wealth of a certain level, started traveling the world and spending money across the world. And that's changed in the last couple of years. But as India hits that phase of GDP per capita, this might be a little different. We might choose to travel within the country and spend a lot of money within the country. And therefore, I think the benefit of that to the whole sector can be very structural in nature.
Shiv, we leave the conversation here for now. Thank you very much for joining in. We will slip into a very short break on that note. On the other side, we'll be joined by Nilesh Shah of Envision Capital and Dharmesh Mehta of Capital Advisors to talk more about the markets. Shireen will also be joining in with a whole host of guests. Welcome back. Adani Enterprises is surging after reporting their numbers. The net profit is more than doubled to 1,800 crore, which compares with a number a little less than 900 crore rupees. So 1,888 on the bottom line. The EBITDA too for the company has gone up 98% and the stock has moved up. Reliance Industries too is seeing some buying. On the way down, L&T continues to struggle. I think since the start of the day, or at least in the last 2 hours, it's been the top Nifty loser. Following yesterday's 4% cut, we've got another 2.5% gone in that. Nilesh Shah, MD and CEO of Envision Capital, is now with us on the show. Nilesh, before we get to the budget and the nitty-gritties, Paytm, just the way the RBI has relentlessly come after. I'm not sure if that's the right way to put it, but it's just that it's been, a lot of bad news for Paytm, and now particularly this latest one on Payments Bank. How would you read it?
Yeah, so I think the series of bad news just doesn't seem to be stopping for Paytm. I think the regulatory challenges probably started maybe more than a year back, and it's been kind of being
Ongoing.
there very periodically. And I think this time it's probably the most damning one. I wouldn't say it's an existential crisis, but it surely is a very big challenge. And it could take some time for them to kind of overcome this challenge.
So if someone holds Paytm shares, if there is an possibility of an existential crisis, would you recommend selling out if they get a chance?
See, I think the stock price is surely going to head a lot lower, undoubtedly. And the reason for that is because these are growth stocks. They're not even growth stocks. Expectation are these are hyper growth stocks. I think right now hyper growth is ruled out. Growth is ruled out for the foreseeable future. You're not talking about whether you are in a position to even hold your base, hold your core. I think that's really where the big challenge or the big vulnerability is. So I think the case to own it for now doesn't seem to be there. And I think it's the first day of the bad news for them. This is something which could linger for some more time. And in this kind of a situation, even if it takes, say, another month for them to sort it out, a month can be a very long period of time.
3:30, by the way, there is a conference call.
Yes.
And we'll hear from maybe Vijay Shekhar Sharma, Madhur, etc. will be on the call and they will take questions. Wonder if that can do anything to, because the RBI circular is so damning in that sense,
Yes.
right? I don't know how much they can do. But instances like this, I mean, I'm going off a tangent also, bring up the old topic of circuits, right? But there's no exit. I mean, if you, as Rima was saying, if you own shares, you just wait and try at 9:15 in the morning. And but as you said, it perhaps could head a lot lower.
Yeah, I think that's a challenge, and I think unless a stock is not in the futures and options stock thing, I mean, once it hits the circuit, lower circuit, you obviously don't have the exit, and that's the challenge. Maybe if this situation happened maybe a year or two later, when it was part of F&O or maybe part of an index, then this situation would not have been there. But that's what it is, and I think this whole circuit system, whether we like it or not, it's been working well for our capital markets, our equity markets. I've seen this for the last 10, 20 years, and I think, it has its positive, it has its own set of challenges.
Nilesh, okay, let's talk about the one set of stocks that's cooling off finally a little bit, and I'm talking about PSUs now. I don't know what to call it. I mean, after a 200% rally, you get a 2%, 3% cool off. How would you approach this part of the market, considering that this interim budget is out of the way, but then you have July, and then you need to see what comes forward in terms of more policy continuity. Even today, there was some mention on railways, but no major capex numbers thrown around. What would you do with PSUs now?
So I think for now, the valuations surely look challenging. They definitely look overstretched. Okay, leave aside the PSU banks because this budget is done a lot of good to them. The whole path to fiscal consolidation, a significantly lower fiscal deficit estimate for next year, obviously is cooling off bond yields and driving up bond prices, which is good for PSU banks. But outside of PSU banks, I think most PSUs right now look very richly valued. They have gone up quite significantly. They're getting priced in like growth stocks, and they no longer represent the kind of value which they represented 2 or 3 years ago. So I clearly think for now, while there might be a structural change to them and they might end up becoming much bigger enterprises in the next 5 to 10 years, but I think a cool-off is warranted in them. I'm not saying a very severe sell-off, but a cool-off is surely warranted, and maybe wait for better or lower prices to get into them.
Just on that, a follow-up. Now, once the election is out of the way, one is waiting to see if this, divestment really starts taking off. And Prashant was also discussing this with our earlier guest, that this is as good a time as ever, right? And I don't know why they waited, but they have, maybe elections. As and when those OFSs start hitting the market, could it really puncture the whole PSU move? I mean, is that a risk that we're kind of walking towards? Or do you think the market will treat the divestment and digest it quite well, actually?
Yeah, I think it will treat it well. See, I clearly think right now, I mean, 2 years back or 3 years back, some of these OFSs were being looked upon as basically capital raising exercises. Today, the government's finances are not as constrained, and so they are not getting perceived as capital raising exercises. If at all, mutual funds or some of the institutional investors who are getting fresh liquidity, they're looking at this as an opportunity to be able to park that liquidity and buy into them. So the whole negative narrative has now become actually a positive narrative. And a more free float, which means the chances of getting into market indices, having a higher weight. So that's now so that's how the narrative is now playing out.
OFS is no longer bad.
It's no longer a bad word. It's no longer a bad word.
You know, it's a stark contrast to what we should see a few years back, right? And
Yes.
OFS is announced, you have LIC coming and picking up bulk of that,
Yes.
and after some time the stock starts trickling down.
Yeah.
Case in point being in NHPC. You know, they didn't, government took some money off the table. In the last 10 days or so, the stock is up, what, 15-20% or even more than that. So the entire perception actually has changed. And also, if you look at, you know, companies like Concor, IDBI, yes, we're waiting for the divestment to take place, but the stock price is still at the 52-week high. That's tell you the kind of interest in some of these names. Just thought we'll put that point on board.
Yeah. And one more thing, I think is also some of these PSUs are in sectors which have become the flavor of the season. So 2, 3, 4 years back, nobody wanted to buy energy stocks. Renewables was pretty much unheard of. Today, when you talk of names like NHPC or some of the other PSUs, they are part of emerging themes. Whether you call this as energy transition or renewables or any of the other, they've become clearly the flavor of the season, and that's also what is attracting investor interest into them. And they seem to be meaningful players. I mean, whether you look at NTPC and you speak to most investors, they really don't talk about it as now a thermal energy company. They are talking more about their initiatives of investing in renewables, the green energy, and all of that. Versus that 2, 3 years back, they were supposed to be, you know, guys who are probably spoiling the environment.
Indeed, and I pity those who said touch me not, you know, for some of these companies because you missed on the biggest rally possibly. Now let's just hold that thought. You know, let's get in Dharmesh Mehta as well, Managing Director and CEO at DAM Capital, who joins us on the show. Hi Dharmesh, good to speak to you. Would like to speak to you more often though, but on the big day you join us. Tell us, what are your first thoughts with regard to Budget 2024 that was just announced?
And Ajil and the team, how are you? Well, this was a non-event in that sense because nobody expected the budget to finish so fast. Everybody was, you know, surprised, including you guys, saying what happened suddenly. That we had the shortest interim budget ever. And I think so, you know, the economy is in such a good shape. You don't need to tinker around too much any which way. So I think it was the most ideal time for a short budget and not to tinker on anything, especially in the interim, and wait for the election to get over and then come with the full and final budget.
Okay. Dharmesh, hi, good afternoon. You know, you look at a lot of the deal action, the primary market action so carefully. And that's what I want to ask you about, because we heard some noises today and we'll probably hear more on a lot of the sunrise sectors, right? AI, digital and things like that. As more announcements come through, what is that entire ecosystem telling you in terms of primary market offerings? What are the valuation, what's the valuation chatter like? And what should we prepare for in terms of new paper hitting the market as we roll on beyond the election season?
I would say it is still too early for these companies to hit the primary markets. There will be more private markets which will absorb this paper first. And as you see in the tech companies also, you know, people took a lot of time to understand those tech companies, and even now they're struggling with the valuation. So I believe the sunrise sector is still a little far away for the primary market as of today.
Dharmesh, hi, afternoon. What about, you know, stake sales in PSU companies, government companies? Will we see a big year for that in 2024?
I would say it's the ideal time because there is enough demand in the market, and as I always say, supply brings demand, not the other way around. So if they intend to sell them, I think so. Those, you know, sales will go like hotcake. But you know, if I'm a government, I'll also see what is the need of the money as of today, and these companies are going to do actually better day by day the way things are shaping up. So there's no rush to sell because you've seen the valuations have actually moved up substantially in the last few years. So they'll take their time to sell it down rather than just sell it because, you know, markets are hot. I believe these companies are on a good growth path, and the government will be very sensible to sell them not too early.
And I think the sense also is that some of these valuations are not fleeting, right? I mean, there's no, maybe in some cases there is, so I can't say that for all. but smaller, but very few. Generally, the larger ones, I mean, there is a growth story. The company is actually doing well. Actually, we were just discussing earlier with someone that if you look at the third quarter earnings season, it's the public sector banks which will perhaps see earnings upgrades. Private banks have all at the margin, disappointed a little bit here and there. Dharmesh, how's the market itself looking to you from here?
I think so. It's a tough market if you look at, because valuations are not cheap. But if I look at the large caps, they're actually very reasonable. My Nifty P is not at the highest or we've seen, or it's crazy. I think the valuations are reasonable on the large caps. And I believe that's what's going to drive the FI flows this year. And they actually come to India because they missed out India last year, as you know. And the China story is not looking great as we speak. There's no other option to actually come to India. So, and the large caps are reasonably valued, not overvalued. So you'll see a lot of FDI and FI money still coming in this country over a period of 1 year. Small caps have the exuberance, but those are high risk stocks which people know when they invest in. But are we looking at some catastrophe, or you're talking about some large scale sell-off? It doesn't look like as of now. Even in the mid-cap segments, you'll have your regular correction of 20-25%, or not some real scare, which generally we see sometimes.
Dharmesh, there are 8 strategic divestments which are currently in various stages. You've got IDBI Bank, BEML, Shipping Corp, and then some others, on the unlisted side like Ferro Scrap Nigam. And the government is also yet to seek expressions of interest for Container Corp. So amongst these, which ones do you think will move the fastest?
I'd not like to name few of them, but I'm very sure if government is out to sell strategically, many of them will see very strong interest and in fact good valuations. I believe there's a lot of value to be made in PSU stocks. So as and when people buy strategically versus financially, there's humongous amount of money which you make strategically. So I won't be surprised if you see a lot of strategic investors coming in those names.
By the way,
few months will be difficult as we see the banks or something, but the rest of them actually should get very strong interest.
Since we're on the subject of PSU stocks, I thought I'll pick out some names. I mean, look at the way these moves are happening in an ITDC, Indian Tourism Development Corporation, surging 17% right now. There's a Hoodco, which is up about 15-odd%. Then, of course, there are banks, the PSU banks, which are up and about. There's also NBCC, which is having a great afternoon, about 5% higher. So while some of the PSUs on the railway side are seeing a little bit of a cool off, and you've got new names surging on the screen really there, up and away. So Dharmesh, we were discussing primary market action. You said that, okay, wait up on the new sunrise themes of AI, etc., or maybe even energy transition. So, what else? Again, going back to that question, will it be sort of any specific theme? Are you seeing a lot of buzz? For instance, we've had some defense companies come out. We've had the whole EMS space very, very active. What do you see on the horizon in terms of primary market action as we go on through the year, in the foreseeable future at least?
See, we were the first in the EMS space, and we still continue. That space is going to see a lot more demand coming in. The kind of growth opportunity which you see in EMS, you're going to attract a lot of capital. So I think so the EMS party continues for some more time. Valuations may correct a little bit, but I think that there's going to be strong interest in EMS and manufacturing as a whole. So I think so that strategy still continues. And you're going to see a lot of consumer companies also coming in slowly, and you're going to get some kind of, IPOs coming in that space. Anything related to defense, railways is hot cake right now. So those are getting sold like, very, very fast. But I think so you're going to see a lot of paper coming in the market. So the only thing is there's infinite amount of paper coming to the market. So one has to be a little cautious on this. But if they're priced rightly, I think so there is enough demand today. If you look at mutual funds, they're getting almost 17,000 crores SIP every month. So they have to invest that money, and they are the ones who are actually going to slowly load up those IPOs which come at a reasonable valuation.
Okay, all right, Dharmesh, good to hear that. On that optimistic and positive note, we'll thank you for joining in and giving us your first thoughts in terms of the budget as well as the outlook on market. Wishing you a good rest of the day. But let's get in Timsy now. She joins us to give us more details on the new direct tax scheme. Timsy?
Well, as you rightly mentioned, the new direct tax scheme, something that found a special mention in PM's address, and Finance Minister Nirmala Sitharaman also said categorically about. It's about stability, tax stability and ease of doing business. That's what the aim is, and this time the idea is to give benefit to the taxpayers who've been paying taxes, and that's what the government said, that they will withdraw old, petty, non-verified non-reconciled or disputed outstanding direct tax demands. Now, this was at the lowest strata, and about 1 crore taxpayers, that's what they are looking to address to. 1 crore taxpayers will get the benefit. Now, what will be the withdrawals for? The withdrawal of demand will be for up to 25,000 rupees pertaining to the period of up to FY 2009-10. And when it comes to the other demand withdrawal, up to 10,000 rupees for financial year 2010-11 till 2014-15. The scheme to benefit around 1 crore taxpayers. And yes, the aim being scheme to ensure ease of living and ease of doing business. So 1 crore taxpayers will get this boost, will get this benefit of non-verified, non-reconciled and disputed demands, outstanding direct tax demands. That's what the government is looking at addressing.
Okay, all right, Timsy, thank you very much for that. Guys, anybody has any outstanding tax issues with the tax? Some good news, huh? If they're old legacy ones, I'll go and check up just in case.
Actually, I know, but I think it doesn't fall in the
that
up
threshold.
to that. It's
pre-2010. Basically, if the tax dispute was 25,000 up to 25,000.
10 to 14 is 10,000.
Your disputes must be around 2, 3, 4, 5 lakhs. Nothing less than that.
ऐसी चीजों पे मजाक नहीं करते.
Pre-2010.
No, it is a real pain. So in that sense, it's a great move, right? It's a big irritant. It causes anxiety and all kinds of things. So withdrawing some of this, really good.
And absolutely. I mean, it's pretty much in line with the ease of living kind of thing. So I think it's good. It's good that at least some of these small old irritants, which are large in number, I think are just kind of eliminated. I think it's a big positive.
I just wanted to get your thoughts in again on this capex number. So one of the big drivers for the PSU stocks was this large capex spend of 35% last year. And that drove very strong order wins. The order book was swelling, and therefore the market was giving that expected earnings multiple, earnings growth and multiple going ahead. Now, if that growth rate of spend is going to come down from 35% to 11%, will that not slow down the kind of order wins we're going to see for some of these, PSU companies, and therefore will it hurt the earnings expectations?
So I think it's got a bit to do with the change in reality. 3-4 years back, nobody wanted to actually invest in infrastructure or lend to infrastructure projects. That was pretty much a no-go area, and therefore clearly it had to be the government which had to step in as the anchor investor, as the anchor lender, and come in and therefore allocate more money from the budget to the sector. In the last 3 to 4 years, infrastructure now has become no longer the kind of no-go area, and now private capital is willing to come in, either through equity investment or through lending. Also, you're going to see foreign capital come in as the Indian bonds become part of the indices, all of that. So now probably the government is trying to pass on the baton to the private sector, saying is that, look, you guys can now come in and lend or invest. And therefore, the need for government to kind of now incrementally allocate that much capital may not be there. Keep in mind, 11% still is a very large number on a base which has probably gone more than 2x over the last 4 years. And secondly, as a percentage of GDP, that number still is 3.4% versus 3.3%. That 3.4% is like at a historic high. I mean, many years back, that number was sub 2%. So these numbers are huge. So to that extent, I think it's still kind of, it's par for the course.
On the point of capex, sorry, just to come in over here, since Rima asked that question, we had Mr. Amitabh Kant on the show just a while back, and he was, constantly making that point that it's time for the crowding in of the private sector.
Yes.
Haven't seen too much sign of that as yet. Your thoughts on this, Nilesh?
So private capex, yes, it's still not yet picking up. Though, of course, the government had reduced the tax rate for manufacturing companies maybe 5 years back so that they could basically be incentivized to come in and expand capacity and set up new units. That has probably not happened to the extent that it may have been desired, but that's because the capacity utilization was trending below long-term averages. Now that is trending above long-term averages. So I think probably, again, it might just be a matter of a few months before the private sector comes in with its own share of capex. But otherwise, still that doesn't happen. I still think the economy will have to rest on this pillar of public sector capex.
Okay, all right, Nilesh, we appreciate you coming down to the studio. Thanks so much for joining in this afternoon.
Thank you.
Looking forward to chatting up with you rather soon. Well, for the time being, let's turn our attention to one of the top sectors of the day, the PSU banking names. They're doing very, very well after the government stuck to fiscal prudence, and that's what's caused bond yields to cool off as well, which in turn will result in treasury gains to PSU banks. Abhishek joins us to fill us in with a quick analysis on that. Abhishek?
As you mentioned, fiscal prudence will aid in GSEC yields to soften. I've been speaking to various analyst estimates and to certain treasurers as well. They say that there are good chances of, bond yield or 10-year GSEC cooling off by anywhere between 50 to 100 basis points is what the range they have given me. So this positive news for PSU banks that FY24 budget deficit target is at 5.8% of GDP, FY25 is at 5.1% of GDP, and target is to reduce the fiscal deficit to below 4.5% by FY26. So prudent fiscal targets will aid in decline of 10-year GSEC yields as well. Gross and net market borrowing through securities for FY25 is estimated at rupees 14.1 lakh crore and rupees 11.75 lakh crore respectively. Now FY24 RE gross market borrowings is at rupees 15.43 lakh crore. So lower borrowings can also aid in bond yields softening down, and this can help the treasury profits of the entire PSU pack who have GSEC securities in their portfolio, especially in the available for sale category. Back to you.
All right, Abhishek, thanks very much for that. I mean, that's a sector which is doing well, and the Nifty PSU Bank Index is it was up 3. It sold off about 1.5%. It's back up, I think, almost a full 3%, 2.93 or so. We'll take a very quick commercial break here. On the other side, we'll be joined by Sandeep Bhatia of Macquarie. Devin Choksi will also be with us, and Gautam Trivedi of Nepean Capital will come in as well. Focus stays, of course, markets last 40 minutes of trade coming up.
Welcome back. Well, we're going through budget announcements one by one, and now let's look at railways. It seems the CapEx announcements have kind of disappointed the street a little bit, or perhaps it's just become an excuse for profit-taking after a surge of 200, 300, 350% on a lot of these stocks. We have Hormaz joining in with the latest. So Hormaz, little bit of red today, right?
Absolutely, a little bit, as you can say. It's not a 5-6% kind of a cut, but a 2 to 3% cut. And as we can call it with the railway stocks, they are kind of sulking at the moment because of the capex announcements, as you mentioned. So IRFC, RVNL, IRCON, RailTel, all of them are trading lower between 2 to 3% after the FM speech. And the capex announcements that were made today, they may have disappointed the street because 2.52 lakh crore were allocated to the Ministry of Railways. That was higher than the 2.4 crore number last year, but not as high as the street was anticipating, because this is around about 5% growth compared to last year, but the street was anticipating somewhere between 10% on a conservative basis. And brokerages like Nirmal Bang also said that railways should get a higher share of the capital allocation that the FM makes in this interim budget. Now, some of the other announcements made by the minister during the budget speech were the 3 new railway corridors that she has announced. And those 3 corridors are the energy, mineral and cement corridor, the port connectivity corridor, and the high density traffic corridor, which according to the finance minister will improve efficiency and also reduce logistics cost, thereby accelerating the country's GDP. And the other announcement that they made were around 40,000 ordinary bogies that would be converted onto Vande Bharat standards for the safety and convenience of passengers. So not extremely big bang announcements, but which is kind of expected considering it was the interim budget and not a full-fledged budget. But as you said, that the stocks having had a run like that, having gone up 100%, 200, 300%, and with RVNL and IRFC in particular, they were up 70% in January itself. So a little bit of profit taking, not unsurprising, but par for the course, as you can call it.
Okay, all right, Hormaz. It seems some of these railway companies, looks like they missed a couple of stations. They zoomed ahead, and now, in fact, they're just catching up because the way these stocks have run up in the last year or so. Well, before we move on, just want to pull up the Maruti stock. Those numbers look quite good. They almost clocked 200,000 units in a single month. That's a big growth if you look at it on a year-on-year basis. It's close to around 15% growth on a year-on-year basis, so that's looking quite good. Exports on a low base were very strong, though. That's up close to around 37%, and domestic sales as well, up in the early teens, up close to around 13%. That explains why Maruti now is one of the biggest gainers, speeding away as we speak. But let's welcome our next panel. We have Sandeep Bhatia of Macquarie, Deven Choksi, as well as Gautam Trivedi of Nepean Capital, who joins us on the show. Good afternoon, gentlemen, and thanks so much for joining in. Well, Gautam, let me put this question across to you. And my colleague Hormaz was just talking about these railway stocks flying away. And maybe, in fact, now they're a little bit disappointed because we were prepared for an interim budget, but maybe the street was hoping for something more. What's your view on this entire railway as well as defense theme? Because both those two pockets are a little bit soft today, though they've seen a big run in the last 12 to 18 months.
Well, I think to your point, Nigel, the run in the last 12 to 18 months itself has played out very well, and it's factoring in a lot of more. I would say factoring in as much as FY26 into the numbers in terms of the way these stocks have run up. So I think given the fact that, yes, I think that the push from the government for both these sectors still remains very strong. But the fact is, I think profit booking at some point was necessary. And I think that's exactly what's happening. Nothing has otherwise significantly changed from an order standpoint, at least not in the budget.
Sandeep, the question for you is that is there anything in the budget which changes your investment narrative? Would you be making any changes in your portfolio, weightages up, weightages down, in, out, based on what we've heard?
I think this budget essentially gives me the message that India is in a long-term growth path with actually lower interest rates than would be for most Western countries. The consolidation in the fiscal deficit consolidation is a very good thing, and India has been on this path for at least 3 years. India did a lot of right things, especially post-COVID, because we didn't spend as much. The US, the largest economy in the world, is actually cranking up a fiscal deficit. It is not able to control its inflation as much. India, on the other hand, has controlled fiscal deficit and continues to be the largest large economy, which is the fastest growing economy. If you look at this just 3 years, if you project this 3 years on, assuming the same kind of policies continue after the elections, India's entire consumption, durable, banking sector will all be for a massive positive benefit. We've seen some benefit come through in Maruti, in autos. Interest rates will continue to trend down. There would definitely be, therefore, better lending. Corporates will also benefit. Currency will remain stable. So I think it actually shows you what can be done if we have a stable policy, and that continues for the next 3 to 5 years, which I hope will happen.
All right. Hi, Sandeep. Good afternoon. Nigel on this side. The street was bracing for this mid-teens earnings growth. Suddenly it appears some of these banking names a little bit under pressure. Could be just in the near term, not a big structural change. But give and take everything that we've seen from the banking names, is that earnings growth at risk that we are factoring in for FY25?
I think near-term earnings growth will be at risk. I think there was a lot of anticipation that this kind of positive cycle will continue. I think there's been a bit of a hiccup there. But if this fiscal deficit consolidation cycle continues, I think public sector banks are the largest beneficiaries. SBI is a beneficiary there. The private sector banks, I think they may not be as clearly a beneficiary as the public sector banks, because most people think the public sector banks are very short cycle. So the benefit to the public sector banks potentially is higher, because this could be a longer cycle benefit for public sector banks.
I want to extend this debate around banks with the rest of the panel as well. So let me bring in Deven. Deven, good afternoon. Good to have you on the show too. So initial thoughts, of course, on the interim budget or any specific takeaways. And then really the question to both you and to Gautam, because I think this banking dilemma is the immediate sort of issue before the market in the near term right now. And I want to get both of your sort of comments and thoughts on this, and whether this is just a passing phase, whether we're making too much of it, or whether this could become a bit of a slightly more important hiccup that the market can't ignore. Deven? Deven, I think you're on mute.
Okay,
I think while we fix that, Gautam, let me take that question to you in the meantime. Banks, and really, I don't think the street was prepared for any kind of sort of disruption at the end of the third quarter. Maybe just some minor compression on margins. But what we've got are bigger questions than that. How do you see it?
Fair question you raised, given the fact that I think the government still, whether we like it or not, seems to be still the biggest spender in terms of whether it's infrastructure and doling out subsidies, etc. So the bulk of the capex is still being shouldered by the government of India. Unfortunately, we've not seen that pick up as yet in the private sector, which we've been waiting for the last at least 2 to 3 years. So the fact is that on the corporate lending side, you don't see that pickup. Almost every second promoter that I meet ends up saying, I want to get to net debt zero. So there is some sort of a race to get to net debt zero, in the hope that that basically we end up having better cash flows. The market ends up re-rating our stock price, and the burden of debt, which is unfortunately the wrong way to look at it, because every company should be having a judicious mix of debt and equity, but there seems to be some aversion even now to debt, given what's happened to some of the over-leveraged companies. So given that backdrop, the question I have really is that will banks be focusing still and competing with each other more on the retail side and less on the corporate borrowing side, which is the government doesn't come to banks to borrow, the private sector does.
All right. Gautam, I think we had this chat a couple of weeks ago and we spoke about various other financials, and I think IRFC as well was another stock that we had discussed at that point of time. And I think you were still fairly positive on it. And after the big run, the stock did even better. What's your view on that, and how do you look at the other financial themes?
I think IRFC is a unique case. And again, not all of them have performed as well as it has. So my view is that, continue holding something that's performing for you versus trying to sell something, a book profit. And because then what do you do with the money, given exactly what Sandeep said, that, the next, I guess, few years for India look extremely sound from a fiscal standpoint, from a corporate earnings standpoint, and political stability standpoint. So given all of these factors, I think, my view to people is, if you've made money in a stock, even if it's made 2 or 3x for you, But if the runway is still strong, you're still looking at a 20 to 30% top line CAGR, earnings CAGR, hold on to these stocks. Don't sell them.
Sandeep, L&T is the poster boy of India's infrastructure spend, capex spend, but the company is struggling when it comes to its numbers and the old legacy orders. Thoughts on L&T from here on?
So L&T is a very complex entity, and it essentially has multiple parts to it. The large part, which is sort of still growing strong, is of course the international orders, and the domestic orders are also there. I would think it is a slow burn situation, as pointed out by Gautam. The capex cycle is coming in much later than what people thought it would come in at. So on L&T, I think there's still some time, and the wait would be a year. In the interim, please watch out for geopolitical movements. We have seen that, time and again, the construction companies, especially for international orders, face pressure when there are some negative developments overseas where they are operating and the projects get impacted. So I would be careful about that. So I would still think the best stories would be India domestic, especially in the manufacturing and capex side.
So, Sandeep, just to expand on that point, since you're still optimistic on manufacturing and capex, just complete that point on banks as well. And what's your own thought? Gautam raised a very, very, very interesting perspective, and it's true. 10 years back, everybody was over leveraged and everybody wanted to expand, and today we're in the polar opposite world. So in that context, how are you looking at large cap financials, and what do we do with the historic high price to book multiples? I mean, do you see them coming back?
So if this current fiscal path continues, India will benefit from longer term lower interest rates. Consumers will benefit from lower term interest rates. The most important statement which Gautam made was the attitude of businessmen is still to cut debt. Right, and that is a fact which we all witness. And the memories of what happened in 2012, 13, 14 are still fresh in the minds of people. I would think if we see this fiscal consolidation happen, there would be therefore a mix of debt and equity coming through. Today, equity looks extremely cheap because the PEs are very high, and we can see capital raising happening. A bit of semblance of correction, therefore, in the market will actually help companies to look at raising some more debt rather than just depend only on equity or so on. So I would think wait for 6 to 12 months. Capex definitely will pick up. There's no doubt about that in my mind. But whether it gets funded entirely by equity or by debt or a mix of both, we'll need to wait and see.
So what's the better play, Sandeep, then from a market standpoint? I mean, if you want to play for capex, then should you stick to the big names like an L&T or an ABB, etc., or should you play it through financials, which has been traditional wisdom?
I think the big names of L&T, ABB cannot be the bulk of your portfolio. The advantage of playing financials is that you get not only the consumer lending, not only the corporate lending cycle, but also you get the consumer lending cycle. And on top of that, which I've been highlighting from the very beginning in this conversation, you get the the lower interest rate benefit also come through. So all told, I think financials should still be the bulk. The real question for every market participant is that whether we will see continued fiscal consolidation and responsible fiscal outlook. If that happens, public sector banks are the best place.
Okay, all right. Just hold that thought, gentlemen. We have Titan's numbers that are flashing for you on the screen, and we just have the profit number that's flashing as of now. And it appears just on the bottom line, there was a very, very small miss. Top line, I think, is fairly in line with what we're working with. For the time being, the stock is down. But I think the two numbers that we've got pretty much in line with what we were expecting. A small miss on the profitability front, and the top line, I think, is more or less in line. We'll wait for the profit number as well. Remember, for Titan, we get a cheat sheet that already comes out, an operational update. So we already have that with us. These numbers look pretty much okay, but the room for disappointment is very limited, going by the valuations that the stock is trading at. Mangalam will join us to give us a quick insight into that name. But since we're talking about inward-facing themes, Gautam, I wanted your view on the real estate theme. We have real estate companies, the MDs, the promoters who join in, and they sound so confident, that it's just the second or the third year of this 10-year cycle that we're talking about. It breaks my heart because I can't get into a bigger home. But be that as it may, how would you approach that theme? Would you look at real estate companies? Would you play it, say, via pipe, cement, or would you go for housing finance companies? How do you play this theme if you're bullish on it?
Yeah, fair question. I think the demand in real estate, of course, also has been aided significantly by the money made in the equity market. So it's every bull run, I've seen this in my working career, that as the bull run, I wouldn't use the word peaks, but as the bull run, at some point, people realize that maybe we should book some profit and buy a home for us, for our children, or move into a bigger home, which I hope you do also very soon. But the fact is, I think that momentum which is there in the real estate sector, which was dead literally for the last 8 years, has come back with a bang, which is the good news. And I think even today's budget, in some sense, again, it's more lower income housing. The fact is, the runway for housing in this country is huge, and it will continue for the next several years and maybe several decades. So I think from that standpoint, the real estate companies, in terms of the run-up in the stock price, has been phenomenal. Now, I was talking to, for example, one of the ceramic tile manufacturers. I'm currently in Delhi, and I was meeting some of these folks. They said that last quarter hasn't been great, but the fact is that a lot of their demand comes towards the end of the construction cycle of projects, and they're expecting the next 12 months to be actually quite good. So I think given the run-up in the real estate stocks themselves, I think cement and the building material space is where I today put money on.
Okay, all right. Got that. By the way, just take a look at Titan's numbers. The top and the bottom line didn't look too disappointing. But on the EBITDA front, there's a miss. There's close to an 80 basis points miss in comparison to our poll, and that explains why the stock is down closer to 2.5% or thereabouts. But let's get in Deven into the conversation. Hi, Deven. Good to see you in, and glad we got all of that sorted out, so we have you back with us. Your view on Maruti first. The biggest gainer, I think, today on the Nifty, it's up close to 4.5%. We had the operational numbers that came out. They almost clocked close to 200,000 units in a single month, with good growth both on domestic front as well as exports. Your view on the stock?
Hi, Nigel. Good afternoon. Well, I think the most importantly for Maruti, the product portfolio shift is definitely helping them more in the area of margin than in the area of revenue alone. And that's practically very important. As I think more amount of cars being bought, which is the SUV category, where the margins factor remains relatively on the higher side, it ultimately helps, I think, the companies like Maruti, even for that matter, even Tata Motors in this particular scenario, where I think the larger amount of optic on the SUV is basically giving them a better amount of realization in the margin. So this trend is likely to continue. As we see it, I think most of the companies are introducing the models in this category. So this trend is likely to continue. And as we see in this particular month, I think some amount of price increase taking place. Along with that, in the later part of the year, the prospects of interest rates coming down, they all are well as far as I think the likely position for the auto companies in particular is concerned. We should be seeing relatively better performance continuing in the subsequent quarters as well from most of the auto players.
Okay. By the way, just looking at global markets as well, while we're digesting, of course, all these big events here at home, gentlemen, just want to point out that European markets are still sulking a bit. There's a little bit of red, and we of course had that disappointment from the Fed overnight. Some of the Asian markets are weak. So in that context, I think we've done rather well. We've kind of brushed aside some of the disappointing global developments, and then Gautam, therefore, let me ask you, what next really? We're done with the budget. Now we move to the general election. I think the market's, going in with complete consensus on that. So what lies ahead? 2% away from all-time highs. What next for this market?
Yeah, so I think let's look at, separate two things. One is the market, one is the, underlying fundamental economy and how that's behaving. If you look at on the fund flow side, I think it's the biggest concern that I've voiced over the past about 6 months or so, including on your channel, is the fact that the reemergence of China, and that's really a concern from a FPI flow perspective. I don't think that impacts domestic flow, and that obviously remains extremely strong. I've spoken to a whole bunch of domestic mutual fund managers, and they still continue to see strong momentum in domestic flows into their funds, which is good. But on the FPI front, we've seen already in the month of January, 25,000 crores of selling. China's taken in already 6 billion of net northbound inflows into that those markets. So as a result, I think our concern, given where we are in terms of absolute valuation, 21 times calendar 24 PE versus China, which is about 9.5 times, I think that is potentially a concern from a flow perspective. But otherwise, I think domestically, as I mentioned earlier on this interview, that the fundamental economy is doing extremely well. I don't think domestic investors care much about FPI flows because the SIP momentum, which is there, I don't think is going to get turned off or slow down anytime soon.
You're basically saying China will do well, right, Gautam? There are some China mutual funds offering these China funds as well.
My point really is, I'm not China expert. All I'm saying is, in terms of valuation, when I speak to foreign institutional investors, they find China at this level significantly more attractive than other emerging markets.
Sorry.
No, go on.
No, I was just saying that there are, I think there is Mirai runs a fund, there are a few others. But, the last time people got really bullish on China tech, that went down. There was another downturn, a bigger downturn. But maybe, at some point this year, we will see the final bottom and things will start to do better. These things are cyclical more than anything else.
And the counter argument to this India versus China thing is, India is getting premium valuations because you are giving premium earnings.
No, but the thing with China is what I was saying was that the problem is what's happening in China and whom do you believe? Because just over the last 24 hours, you've got the Caixin PMI numbers, which are showing third straight month of expansion. That number is above 50. Then you have the official data, which is showing contraction. So sitting here in Mumbai, kind of hard to guess what's going on.
But everything's good at a price, I think, and that's the reason why I think
it's all at some price, basically. All right, gentlemen. Thanks very much for joining us, Sandeep, Gautam, Deven. Appreciate your time here on CNBC-TV18. It's always a pleasure. We'll move on our segment, D Street Chatter. Nimesh has been speaking with a whole bunch of people across dealing rooms to get a sense of what they made of the budget and, of course, what from here. Nimesh, tell us more.
Hi, Prashant. So, day of consolidation as the two big events are out of the way, right? The Fed outcome last night and the interim budget. From an interim budget point of view, the market feedback is no bad news, is good news. So life moves on. And there are individual gainers as well. The mid-cap index may look weak, down 0.5%, but there are equally amount of large gainers as well in today's market. The PSU basket, the PSU housing stocks, a lot of PSU stocks are buzzing in trade. The drawdown in the broader markets is largely on a few large stocks like, Paytm is down 20% down circuit, India Cement was down, so is Aurobindo Pharma. So those stocks are dragging the broader markets down, but there are equal number of gainers as well. I've been saying for the last many days, the institutional interest seems to be within the financials in the PSU stocks, and that's PSU bank stocks. And that's playing out again in today's trade. Big move on the PSU bank stocks. Of course, the cool off in the bond yields is helping. But generally, there is money now chasing the PSU banks out. That's the overall feedback. So net, life now moves on, and there is equal amount of interest back in the broader markets now.
Nimesh, what about stocks? What have you picked up today?
Well, a couple of large blocks that will have an impact on the overall institutional data as well. So watch out for a large block, a disclosure in PB FinTech. There is a large block, 5% equity got changed hands. I understand the P investor was a seller in block, which was an FDI, so it will only reflect in the institutional data. So is the case with the Indus Tower block deal as well. 9% equity got changed hands. A couple of large, P investors sold out. They were FDI investors, and a clutch of domestic and FIs were buyers in today's block. So both the disclosures will be quite interesting, but that will have an impact on the overall institutional data. The second name is Kalyan Jewellers. After the results, a bit soft in today's trade, but Citi is now anticipating a large block. Remember, there is a P investor who's been selling constantly. So again, a large block is expected from the P investor in Kalyan Jewellers as well. So that's the second name. The third name is Eicher Motors. Overall, the autos have done well in trade today, but Eicher stands out largely on back of very strong buy flow. So expect high delivery volumes, and that's largely on the buy side from the larger institutions. And the last name is Bank of Baroda. I spoke about the PSU banks overall, but Bob stands out on strong buy flows, as well as there was a Nomura update as well today morning. So that's helping Bob to outperform in the PSU basket today.
Okay, all right, Nimesh, got that.
So
Thank you very much.
Just one minute. Nimesh, have you heard anything on Fusion MFI? Because they're also, I think, Warburg, and I think there's one more entity which owns. Is that stock's been down sharply since the morning? Anything you picked up?
Not really, Prashant. I spoke to a few large investors as well. Looks like, the Paytm concern is spreading out to all the other financials as well. So whether it's NBFCs, whether it's MFIs, all are under pressure today. It's not only Fusion Microfinance. There was a block as well. Looks like one of the, not the private equity investor, but one of the FI investor would have sold out. but no specific reason for the stock to be down more than 10% in today's trade.
Okay.
Sometimes when you ask Nimesh, have you heard? I want to say he's definitely heard, but I don't know how much he can tell us.
He can say on air.
television.
Yeah. Probably that's the case. All right, Nimesh, we'll let you go on that note. Won't pull your leg any longer. But, since you mentioned Paytm, aside of the budget, that is the biggest story of the day, really. So let's bring in Ritu to just once again dial back and understand all the concerns that the RBI has raised on the fact that, after the 29th of February, customers cannot use, any of the services, not even put more money in the wallet or withdraw from the wallet. From now till the 29th, there is a window open. Let's go to Ritu to understand all the specifics. Still a 20% slam dunk on that stock, Ritu.
That's right, Surbhi, because for all practical purposes, Paytm Payment Bank cannot operate until what period of time? That is yet to be known. But just to distinguish for the viewers, the Paytm wallet or the Paytm app rather that you and I use to make UPI transactions, etc., that is not affected. That's a different payments part of the business. This is the payment bank part of the business on which restrictions have been imposed. What has RBI said? It is said that Paytm Payment Bank cannot onboard any new customers with immediate effect. There will be no deposit, no credit transactions on any of the customer accounts. Even wallet top-ups will not be allowed after the 29th of February. However, if you are a customer who has some money in the Paytm payment wallet, you're free to utilize it or to withdraw your money without any restrictions whatsoever. But no banking services can be provided by the bank, and that includes your bill payments, your IMPS transfers, etc. Because remember, this is a payment bank, which means it cannot lend. All it can facilitate is transactions. And that is where now the activity has been completely stopped. Why this action? And I'll take you back to March of 2022, because right now RBI said it had to take this drastic action because of material supervisory concerns and persistent non-compliance from Paytm. So in March of 2022, they had barred the payment bank from onboarding any customers because of deficiencies in their IT processes, KYC, risk monitoring, and so on. And that even after 22 months, RBI finds has not been satisfied, which is why you've seen them take this action. But that aside, there was already an embargo on them onboarding new customers, and that now continues indefinitely as of now, because there's no sunset clause or no wording in the circular which says that if you're able to comply, we will lift these restrictions. Now, Paytm has said in its statement that this will have an impact of 300 to 500 crores on their EBITDA because of these restrictions, but they're continuing on their trajectory, working towards the path to profitability, and they will be working with other banks here on and not Paytm Payment Bank for the payments business. Now, brokerages, of course, are quite negative on the stock. You have the likes of Jefferies downgraded to underperform with a target price of 500 rupees. Bernstein believes that this practically ends operations for Paytm Payments Bank and adds to the already heavy burden of regulatory burden on the stock. Macquarie believes that this is as good as RBI indirectly revoking the PPI license for Paytm, which remember rests with the payment bank, and that the bigger issue is that Paytm is not in RBI's good books. So will its lending partners, for instance, also relook at the relationships? That remains to be seen.
Okay, Ritu, thank you very much for that. Let's also get in Ambrish Baliga on the show now. We've got about 12 minutes left for markets to close on budget day, and things are very, very quiet. The Nifty is just a shade below 21,700, 35 points down, while the Sensex is lower by 120 points. Ambrish, first, straight away, let's get to the stock that you're recommending, and that's TVS Motors. I remember when the numbers came out, it was on the same day as Bajaj Auto, and Bajaj Auto went up 3%, while TVS Motors was under pressure. So tell us why you like TVS Motors.
It was under pressure despite the fact that the performance was better than what the analysts were expecting. But then clearly I see still value in this stock. A leader in two-wheelers. They have manufacturing facilities in Tamil Nadu, Karnataka and Himachal, and overseas facilities in Indonesia. If you look at the installed capacity, it's about 55 lakh two-wheelers and 2 lakh three-wheelers, and they have a very decent global presence. If you look at the last 9 months, they have sold about 31.28 lakh two-wheelers and three-wheelers. And the industry growth is expected to be 16% CAGR, which is huge over the next 10 years. And in this, the contribution from EVs would be significant. And because of which, for TVS, this is a focus area. About 1,000 crores capex is planned out. They've sold about 48,000 two-wheelers in Q3. If you look at the January numbers, which have just come out, it's about 15,000 EV two-wheelers they have sold, which means they have about 18 to 19% market share. And this segment is growing at about 60%. If you look at the Q3 numbers, which I was talking about, I mean, they had the highest ever revenue, which they reported, 25% growth Y-on-Y, EBITDA margins about 11.2, PAT has improved by 68%. So looking at that, my EPS expectations for FY26 is about 61, and my target here is about 2,440.
Okay, that's TVS Motors. Ambarish, good afternoon. Also want to ask you about the stock of the day, ATM. What thoughts? And I don't know if anyone's going to be a braveheart enough given the uncertainties, but what would you advise to people who are even holding right now and watching the circuit?
I think they have to just keep watching because there could possibly be another circuit because market is clearly pricing in the fact that this part of the business, this vertical will be shut down. But then we should remember that they've still not cancelled the license. So I suppose that small window is still there. And I don't know when the markets will start, giving some weightage to that small window which is open. But then very difficult to, stick my neck out and say that it's a buy at an X price. I mean, I'll still continue to watch.
Right, Ambrish, hold that thought. Let's get in Jay Bala as well into this discussion. Hi, Jay. Good afternoon. Good to see you in. How are you feeling about the Nifty Bank? I want to ask you about that index because 3 straight sessions, it's being a relative outperformer. Is it a bit of a dead cat bounce? So you expect it to go and visit lower levels, say the 200 DMA? Your view?
And that's what it looks like, Nigel. And thanks for having me on the show. And the bounce for SBI, if you recall, go back to my prepared notes of Tuesday, I've mentioned there that SBI could go back to reclaim the 660 high, all-time high, and slightly go over, but it will not be sustainable. So the banking index, in all probability, has put in a medium to long-term top. I'll be quite surprised if the banking index goes any further higher than 47,000. That's the max I'm seeing in this pullback. So to me, it's just a counter-trend rally.
Just 2% away from where we are, and that's it. And on the higher side, right? Jay, coming to you, Jigar Mistry of Boyne Capital is also with us. Jigar, great to see you as always. What did you make of things? And I wanted to come in on this banks.
Yes.
I don't know if you heard Jay was saying that he thinks banks have made a medium-term kind of a top, but that's technical, in reading of the charts. But your thoughts?
Right, Prashant. So as always, great being here in the studio with all of you. I think, see, when you're looking at Bank Nifty, sometimes we think that's a representation of all banks in India, but you look at HDFC Bank and Kotak, that account for 40%. Now, you look what's happening in the banking sector since COVID. Other than these two, a lot of other banks have actually gone up. So essentially, you could now make a case that, those banks which have not run up may continue to not run up, but a lot of other places and other banks might continue to see value. So bottom up, we see, values in even the sort of top private banks per se. But I don't completely concur with what he says.
So you've been bullish on banks for a while. HDFC Bank, have you topped up after the fall?
Yeah, that sort of continues to be among... So for the first time in 8 years, I would say that we have been running this fund. It features even in the top 5 ownerships, but now it's in the top 3. So for the first time, we think... Look at sort of, at 1450 odd levels, 100 rupee EPS, 200 rupees sort of, subsidiary valuations. You then think that, oh, this is the ownership issue, this is what they communicated versus what it is. But you go back, say, 2017, ICICI was in a very similar space. 2018, SBI was in a very similar space. So as we spoke last time around, it's one step away from being a meme stock. We might be getting into that zone very soon.
Any other bottom-up ideas in the last, 1 or 2 weeks or recent?
No, I think, what we are approaching increasingly is that small and mid-cap space in general, given the flows, given the low free float, is getting very, very difficult to pick and choose, right? So sort of the way we have positioned the fund is get a lot more into larger caps. Banks within that is the clear winner. But pharmaceuticals is interesting. Some bottom-up ideas are interesting as well. But that is where we are.
Pharma, financials.
Pharma, financials, some small and mid caps. We can discuss a lot of sectors, but see, think of automotives, right? Two-wheelers, 80% of incremental volumes will be EVs. Now, the market, those stocks have gone up 100%. The market seems to be believing that that's equally profitable as the ICE, which is virtually impossible to happen. Correct. So why are we paying such a huge valuation premium? Yeah, they were inexpensive. Now they are not all that expensive, which is the same argument made for IT as well. Right? That sector has had the worst performance in the current quarter results. We are hiring the lowest number of freshers into that sector. Captives are hiring more than the third-party products. So increasingly, it's not expensive, it's not cheap, but there is no growth. So let's go ahead and buy that at least.
So my sense is you're not too optimistic on IT because frankly, when the reaction after the Q3 numbers with pedestrian commentary, pedestrian performance,
but
the stocks got, the stocks were rallying as if, wow, there's a breakthrough. So
yeah, so I think it's very similar to a lot of, back in the sell side days, a lot of my IT sort of colleagues used to tell me, ADR is up, so results must be good.
Since you're talking about a sell side days, then you should track the metals sector very closely. What's it? I mean, some of those numbers are looking very good. The stocks but are not moving too much up because they seem to be factoring in that in. Do you think ferrous and non-ferrous is looking good from here? Or would you say, Nigel, there are plenty better opportunities? Now I'm not on the sell side where I have to put out a note. I rather avoid it.
Right, Nigel. So there is a reason why I'm no longer in the
But give us a view. I mean, you've tracked the space so close.
So I think back in the day, Nigel, we used to have this whole super cycle, right? Because one country was building it out, and that's not the first time that has happened. You look at post the sort of Korea War, 45, Vietnam War, America used to rebuild. And during that time, you had this super cycles where you start looking at steel in use, aluminum in use, and then you make your estimates from there. The way China growth was different from the other parts was that, let's take aluminum, right? With no bauxite, no alumina, no coal to make power that you can smelt it into aluminum, you become the largest exporter of aluminum. So the way in which China has grown has sort of disrupted the sector so badly that everybody had to create these virtual walls, right? So it started with Europe, went on to US, then India did it as well. So now you're just playing off for those 20-25%. You don't really have years when, say, iron ore is up 100% each year for 3 years in a row.
So that we're not getting those long cycles. I think we're just a minute away from close. Jay, very quickly, before we hit the bell, what is the mothership telling you? The US market, we had the Fed overnight and we've got this wobble now, so what indications? NASDAQ, S&P 500, what are the cues?
Yeah, if you recall from our December conversation, Surabhi, I had said be prepared for a January surprise. And I don't know if you'd count the Fed chairman saying that rate cuts in March is out of the table. Most probably that's as a surprise. And, we got inflation data in January where people are saying that it's if you exclude shelter, inflation is actually not going up. So, my belief is that one final low for the US 10-year yields, maximum, or it's already bottomed. We're going to see inflation come back with a vengeance. That's what the chart setup is. So, the technicals for the Dow is such that it's still got one more higher high to come through. But most probably technology and the broader S&P has possibly topped out. If we see the Dow Jones go up to make higher high and the technology and broader S&P not make new highs, that'll be a confirmation. That's the final top.
Okay, got that. I think we're just racing to the market close now. Maybe we can squeeze in one more question. Ambrish, with this, with the budget out of the way, and we heard a little bit about the railway sector, right? 40,000 wagons to be converted into the Vande Bharat, right? Absolutely. So, are we going to see something there? I think the government has already said they plan to build out 1,000 Vande Bharat trains. The number is under 100 right now. But this number, this 40,000 number would equate to, a much bigger number of trains, I think 2,000 plus. Any thoughts?
No, because 100 Vande Bharat trains are different. I mean, those are new trains. Here, they're talking of replacing the existing 40,000 rail bogies into Vande Bharat standards. So this is going to be a new order flowing out to all these companies. So I think this is extremely good news for people like Titagar.
Although we don't know that, Amrisha, we need to wait because if that's going to be what we heard was 1,000 new trains, but now with this announcement, so we'll need to get maybe some clarity as we go along. But I think we'll wrap up the discussion here. Thank you very much, Ambrish, Jay, and of course, Jigar, thank you very much for dropping by. Appreciate your time here, as always, on CNBC-TV18. We are ending with about a 30-point cut So, like the interim budget, it's a very interim kind of a close as well.
Well, let's wrap up the markets then, Prashant, with all the day's action. So today, for the entire day, we moved in a band of close to around 170 points, 160 points or thereabouts approximately. And from there, in fact, we ended more or less flattish. Well, in terms of stocks that were in focus in today's trading session, you had Maruti that was one of the big gainers in trade today. You had Cipla as well that was up and about in today's trading session. And Eicher Motors, that's been a rank outperformer for this week itself. On the losing end, well, a couple of these domestic-facing themes as well did see some selling. So whether it was Ultratech Cement that was under some pressure, you had JSW as well that did see some selling in trade. Titan came out with its numbers. Well, the stock was a little bit under pressure in trade. And you had L&T as well that was down in today's trading session. From the broader market, the stock that was really in focus was Paytm. It got a rap on the knuckles from the RBI, and that one, in fact, went home with a cut of close to around 20%. And a couple of these lenders as well, Indiabulls Housing Finance, Fusion Micro, both of them were down more than 10%. And there were two stocks that were reacting even to a negative news flow. One was Oro Pharma because of reports of, a visit from the US FDA, from the regulators out there. So that was under some pressure. And you had India Cements because the ED, well, they had visited them. So both those two go home with some cuts. So to wrap things up, well, we moved in a band of close to around 200 points approximately in today's trading session. But, we ended with a mild cut of around 15 to around 20 points out, guys.
Okay, well, that wraps up the market. Bank Nifty, I guess, was the shining star. It managed to retain most of the gains over there, and we'll see if there's any further continuity. But otherwise, mid-cap setting, I think just the market digesting the event, letting it get out of the way, and then perhaps taking a fresh guard from tomorrow.
Absolutely. Historically what happens is if there's a big move on the budget day, you get a move in that same direction, up or down, over the next 1 month. But today, this is nothing, right? I mean, this is absolutely flat kind of a close. So neither here nor there. But I think it's goodbye from all of us here on closing bell. But the coverage will continue here on CNBC-TV18 in just a moment from now. Stay with us.